Hi guys, welcome back to podcast. I'm going to be looking at mocks at my IGCSE class I've taken in Jan 17. These here are on paper 2. Very quickly, there are a number of multiple choice questions. Trader prepares his financial statements. Which explanation correctly describes his reasons for doing it? Well, one, you need to calculate your closing inventory before you do your financial statement, so it can't be that one. Two, yes, you would like to know your return on your investment if you're a sole trader. So that is a good reason for doing your financial statements. 3, to make sure that all financial transactions are recorded. Well, if you don't record them, if you've got an error of omission, for example, then you may never know that you haven't recorded them, and therefore you may end up with them not being recorded in your final statements. So 3 isn't true, but 4, to measure progress of a business from year to year, is true. So 2 and 4 somewhere has got to be answer B. When does a trader send a credit note? Well, it's not when he purchases goods on credit, he'll receive an invoice for that. When he receives a return of goods on credit, yes, that's true. When he returns the goods he purchased on credit, that would be a debit note. And when he sells goods on credit, he would issue a invoice. So it's got to be B. C, trader compared his bank statement with his cash book, and he found the bank statement had deducted the bank charges twice in error, and that one deposit had not yet been credited. Well, less amounts not yet credited. That's the easy one, so it's got to be one of those two. Because we're starting with the cash book balance, the bank statement will be too low because we've effectively taken the money away from the trader twice, and therefore it's also going to be the bank charge error is also going to be subtracted because the balance in the cash book won't have had it taken off at all, the error. Question D, which statement is true about sales ledger control accounts? Discount allowed appears on the credit side because it reduces the amount of money that suppliers owe to the business. Discounts received, well, they don't even appear in the sales ledger control account. They appear in the purchase ledger control account or the total trade payables control account. And E, Agatha depreciates fixtures and fittings at the rate of 10%. On January, she bought some new fixtures and fittings costing $800. An error, she debited them to the repairs account. So the first thing is for that one that the profit figure should be reduced because of the error. So it's understated. The profit's understated because they've taken an expense off they shouldn't. So that would increase the profit by 800. However, you need to also allow for the 10% depreciation. 10% of 800 is 80, and therefore it's actually only understated by 720 because you're going to take some expenses out, but you're going to add £80 of expense in overall. Final one, question F. An amount received from Alice, a credit customer, is credited to the account of Alison, an error. Which error has been made? It's got to be an error of commission. Wrong person's account, not principal. Right, question 2. Okay, so on the Jan 17, question 2, petty cash book. Most people did this correctly. So most people, I think you were given the balance brought forward as being 24 anyway, but they make the imprest up to 120. So that's a debit entry in the petty cash book. And because it's from the bank, you put bank in. Stamps, most people did this correctly. You got your 14 that was actually paid. So that's credit in the petty cash book because they lose cash. And most people correctly put it into the analysis columns. Similarly with the copy paper and cartridges, some of you got this one wrong. Refund from the stationery Okay, a refund means you've got a debit entry going into the petty cash. There's money gone in, not money coming out, which would be on the credit side. Train fare, most people did that correctly. Most people put it into the analysis column. Most people got this one right, but some got it wrong. Everybody put the $29 on the credit side, but then the analysis column, not everybody put it down as being a ledger account. It's a ledger account of office supplies because they've paid some money that they owed from a credit purchases. Taxi fare, everybody put that in travel, I think. Window cleaner, everybody put that in cleaning. Not everybody did this correctly. Don't forget, you've got to add up the total of all the payments and the total of all the analysis columns, and these four numbers added together should equal that total. The balance carry forward then is what makes both sides up to the debit total. So you've then got the 124 and the 124 on the credit side, and then balance carry forward, balance brought forward. A lot of people also added on the extra £108.40 here, $108.40 here, to make it up to 120. You weren't actually asked to do that in the question, but you were asked to then calculate the amount of money that would make the imprest back up. And you were then, after that, you were asked to do the to state what the double entry would be. Obviously, debit petty cash, and then they would have either taken cash or bank or cash book. This one, quite a lot of people got wrong. Part of the reason why we do a petty cash book is to put these totals into the ledger accounts. It saves making so many entries in every ledger account. So it should have been the total of $47 that went into the postage account, not the two individual transactions. And a lot of people missed out this credit entry. You got the refund of $4, and therefore the credit entry has to go somewhere. The credit entry would obviously go in the postage account. Question D. Where are we? Give me 1 second. Changing methods of depreciation, that's consistency. So he shouldn't have done it, he's not being consistent. Manager retiring is going to reduce his profit by $5,000. The problem with that is you can't accurately measure the impact on the business of the retirement of a manager. So that one's got to be money measurement. The Abhinav recorded a sale of goods to Whitehead. He'd seen the goods on display. Right, he's not actually bought the goods there. He's seen them and he's promised to return later. There's been no exchange of the goods, and therefore that would be the realization concept. And he intends to trade for several years, but decided to record his motor vehicle at the possible sale value rather than the book value of the machinery. Well, because he's intending to trade for a period of time, we would go for the name of the principle is completely gone from my head, but it'll come back in a second. It's a one that's going concern, because the going concern concept says that we do or principle says that we do the accounts on the basis that they are going to continue trading for the foreseeable future. Okay, this question was relatively well done. The one where we're looking at accruals and prepayments with incomes and expenses. So, what should we have done? Stationery, we're told the amount of stock at the start. It's an asset for the business at the start, so we've got 182 as a balance brought down. That had to be on the 1st of May. They then bought some stationery for cash. So credit cash, debit the stationery account. That's quite straightforward. and there was also a purchase of stationery that goes in for 217. There was a return of some stationery on the 6th of December, so 53 goes on the credit side. You were told what the inventory was at the end. That inventory at the end is carried forward to the next time period and is part of the next time period's expense. So it goes on the credit side above because we need to reduce our total expense, and it appears on the debit side as a balance brought forward because it's an asset at the start of the next period. And then the difference between the debit and the credit side is the amount that goes to the income statement. So we worked out the income statement figure last. You work out the balance, you put in the balance carried forward first, and then you work out the amount for the income statement. A1 Stationers account, generally well done. You got the balance brought forward, most people got that right. You then added on the stationery that was purchased, 217 on the credit side because it increases the amount that Katie owed to A1 Stationers. She paid 114 off, so that would be a credit in the bank, debit in A1 Stationers account. We debit A1 Stationers account because we're reducing a liability. And there was also, so that was a 53, and then the returns from stationery that cost $53. That's going to reduce the amount of money that Katie owes to the A1 Stationers, and then you calculate the balance carried forward. And then the commission receivable account was generally actually pretty well done. I think nearly everybody got these two figures in the right place. The balance brought down, you're told in the question, was commission outstanding, commission receivable outstanding. That would be a asset when it's bought. Give me. Oh, that's the 30th of April. Sorry, I'm looking at the wrong thing. Oh, they'd already put the balance brought down. Sorry, the balance brought down came straight from the question. So you were told the amount of money that was balance brought down, which was a asset because it was money owed to the business. It's not part of this year's commission that they've received as an income. That then got paid. You got the two transactions where you got paid: debit, bank, credit, commission receivable. You're told that there's 1,590, which is outstanding as part of the question. Okay, that should be part of this year's income. So it goes on the credit side because it's part of this year's income. And for next year, as a balance carried forward, and for next year, as a balance brought forward, it will be on the debit side because it's an asset, it's money that they are owed. You then add up your credit side because that's going to be bigger. You need to make the debit side the same amount with the income statement figure on it, and therefore 3,300 appears in the income statement. And then a couple of quick questions. Name the ledger in which commission receivable account would appear. That's got to be the general and nominal ledger because the only other two ledgers are sales and purchases, and they are for customers and suppliers accounts. And name the section statement of financial position in which the balance of the commission receivable account would appear, and give your reasons for the answers. Well, it would be in there with other receivables, so it would be in the current asset section of the account as other receivables. A lot of people put other receivables as being the section, but it's the current asset section with the other receivables because it's money that's going to be received in the next 12 months.